Hey guys, Chuck Barone here. July the 5th, Tuesday, 2022. And there was a lot of activity in the market to talk about today. First, I want to just say thank you to everybody for tuning in today, everybody for watching this video and supporting the channel. Things are really moving along here, and it couldn't be happening without all of you and your fantastic support you've given the channel. We really appreciate it, guys. Thanks a million. In the markets today, a lot of activity. The stock market was mixed today. It was a very strange day in the market where you have the Dow down fractionally, you have the S&P, the broader market, up fractionally, and you have the NASDAQ, the most speculative part of the market, having a really nice rally today. I'm not sure if that fits with the flight to safety narrative that everybody's been talking about. It looks to me like speculation is back on. I think the market's starting to believe the Fed's going to have a little bit of a spineless reaction to raising rates again. I think the market's starting to factor in that they may not even raise rates again, although I wouldn't certainly want to bet my money on that. The bond market today, another crazy day in the market. The 10-year rallies again to just about 2.80%. It's 70 basis points down from its high at 3.5. And I got to say, guys, I've been a student of this market for almost 40 years. I've never seen the 10-year react like this. I've never seen, I don't even think I can remember the 10-year dropping this quickly when the Fed was announcing rate cuts coming up, let alone rate increases. It's just the strangest phenomenon, something that's literally defying gravity. And we're going to talk about this a little bit more in depth a little bit later on the show. The dollar today, another strong day versus the world's currencies. The dollar index up over 106. Looks like we're going to actually achieve parity with the euro. The dollar is just driving this market right now, and it's hurting some of these other markets we look at every day, such as the metals market, which was just had a brutal day today, with gold down over 4%, or over 2%, silver down about 3.5%. These markets have just been looking very sluggish. I think that a lot of this is less speculators bailing from the market than the strength of the dollar. You know, gold and silver, I think, are going to react more to prices and the way the dollar behaves, and they're going to react to speculation. I think with the dollar being as strong as it's been and looks like it's going to continue to be, I think this is causing these declines in metals. I tell you guys, wait it out, be patient. This dollar cannot stay this way forever with this recession coming up. And I think silver and gold are going to have a little bit of a rally coming up. The oil market, another brutal day. West Texas Intermediate, down 8%. Natural gas, down over 4%. And I think, like all commodities, again, oil, like metals, is falling victim right now to the strength of the dollar. And plus, there is some speculation in the oil market that demand is going to wane as the price increases. We're not really seeing that in the market. We'll see what happens when AAA reports their amount of people who took road trips over this weekend. I think it's going to be a record, and that's going to kind of put this whole idea of less demand to sleep. Bitcoin today had a great day. Rallied back above 20,000. If they can hold that, that becomes the new support line again. I think they're going to test that again to the downside. And if they can get a good bounce, I think Bitcoin could be in a place right now where they might actually have a little bit of a rally. These markets are crazy, guys. I've been emphasizing, and I'll emphasize again, get yourself into a defensive posture. What we're seeing here, none of it seems like, it just all seems perfectly choreographed to create massive confusion. It's a good time to protect yourself. It's a good time to not worry so much about gains as it is to protect your principal, protect the money you have. I want to talk a little bit about this bond market. I got to tell you, St. Jerome, I call him that because he pulls off miracles, and that's how you get to be a saint, had another miracle in the market today. I don't know how this is happening. The talking heads on Bloomberg and CNBC and Fox are talking about this being a safety trade, a flight to safety. That may very well be true, and I've heard Greg talking a little bit about this as well in his blog. But my question would be then, if you're going to have a flight to safety, you want to get your money out of the market, put it in the safety of the U.S. Treasury market, why 10-year bonds? If the yield curve in the bond market is literally flattened out, and it's going to invert with the 2-year actually having a higher rate than the 10-year. So my question is, if you are going to have a flight to safety, get out of this market and try to protect yourself, and you didn't see this recession being something that was going to go on for years and years and years, why the 10-year? Why not the 2-year if you can get basically the same yield on it? You don't commit your money for as long, you have less interest rate risk, there's a variety of factors to pick the shorter term bond over the longer term bond, and it completely goes against what I was taught when I was training as a broker. The way we were taught, it's bills, not bonds, in a flight to safety. Unless it seems to me like in an environment where rates were coming down, you might want to go longer to lock in the higher rate. But in an environment where rates are going up, I think the opposite is true. It just appears to me that the bond market, I think they see a U-turn coming up on the Fed as far as these rate increases coming. I think they think the Fed's going to chicken out. I think they think that the Fed is going to not raise rates this 3 quarters coming up in July. And I think they're even actually listening to the Bloomberg Comedy Hour this morning. They're actually talking about how soon can the Fed start to cut rates again. So this bond market is just nuts right now, guys. I advise you, if you feel like you need to be in interest-bearing stuff and you need to be in these treasuries, stick with the short-term stuff, short as you can, comfortably buy and deal with the yield it's going to have, because it just doesn't seem like the place to be where the smart money is. I think that if the Fed actually does come out and raise these rates again 3 quarters next month, this bond market's going to have a reversal, and it's going to be pretty explosive. I've been watching these markets very closely for you guys. I've been telling you since our very, very first video that we're already in a recession. More signs of the recession appearing every single day. I just was reading. Amazon reports its first quarterly loss in 7 years. So if mighty Amazon is losing money on a quarters, that just tells me the whole economy is tanking down. Amazon has also canceled 13 of their factory builds they had planned. So they're going to start pulling back on their capital expenditures, and I think as they go, so goes the rest of the corporate world. I was reading a statistic that really was surprising to me. They said that Amazon actually takes up 45% of the e-commerce space. So not only are they the dominant one, they're the most dominant. The Federal Reserve is also reporting that there's trouble with the corporate debt market. The corporations, as their debt is expiring, are having difficulty rolling that debt over into new debt. So now we're having a liquidity crunch in the corporate debt market. At the same time, treasuries are rallying like crazy. None of this makes sense. The Fed is talking about factory activity is at a 2-year low. So all of this stuff just confirms us in our belief that this recession is here. It's going to get worse. You hear the talking heads talking about the recession. It's just the funniest stuff ever. They're talking about, first it was transitory inflation, then it was peak inflation, then it was, well, this inflation's real, we're going to have to raise rates, but it won't lead to a recession. And now the new talk is, well, there may be a recession, but it won't be deep. It'll be a very shallow, short recession. I'm wondering, what are they basing that on? Because all the evidence I'm looking at says the exact opposite. It says it's going to be a long one. It says it's going to be a deep one. The statistics say that when you have a recession combined with inflation, the average duration is well over 20 months. The average decline in the stock market is 40%. I think that's where we are. So we have about another 1.5 years of this recession to go. We got further declines coming in the stock market. I think that to think anything else until you see definitive proof of it is a great way to lose some money in these markets. Other signs of the apocalypse I've been looking at. I was reading a report. Now this is on cars. The report said that the average monthly payment has now passed $650 per month. When you combine that with the high cost of rent and mortgages, people are paying $2,000 a month for rents and mortgages, and you combine a $650 car payment in with that, that is eating up a massive portion of people's monthly incomes just to pay for a car and a roof over your head. I don't see how, with these numbers that we're seeing, this recession isn't going to be a deep one. This same report said that 36% of car loans are now for up to 84 months. So people are taking out 7-year loans to buy a car. Now, I guess some cars hold their value, but over the course of 7 years, if you buy a car for $50,000, how much is it going to actually be worth by the time you get done paying it off? I just don't see how this is a recipe for good things for the regular common guy. Our beloved schmuckatellis, our Joe Six-Packs, our blue-collar guys. It's crazy. It said that almost 15% of car payments are now over $1,000 per month. This is more unsustainable gobbledygook that people can't pay $1,000 a month to drive a car. It's just crazy. Moving on to real estate, more signs of the crazy stuff going on. The talking heads on Bloomberg comment this morning were saying, well, is this going to be a correction or a crash? Well, that sounds like bullshit semantics to me, guys. What's really the difference? If your property goes down from a median price of $450,000 down to $350,000, what would you call that? A correction or a crash? I call it pain either way. And this is what's coming up quickly. And this is not an opinion. This is math. This is doing numbers, where the number people can afford on a payment demonstrates that these prices have to come down to make those payments happen. So we got some stuff going on that is crazy. We got big markdowns already all over the country in real estate. I was reading that Salt Lake City, 40% of their listings have already discounted. Tacoma, 50% of their listings have already discounted. Sacramento, 44% of their listings have already discounted. Big price declines are just starting. They're on their way. I think you have people who were speculating in this real estate market, investors who thought they were going to get in and just get rich instantly and forever, running for the hills on this stuff, guys. When you have desperate sellers, that leads to bigger price declines. There's just not a lot of demand for buying houses right now, especially from people trying to finance them. I know there's still a lot of corporate money, a lot of pension fund money in the markets, but without first-time buyers, the markets, they just don't function very well. But what's happening is, because the little guy can't afford to buy a house, now we're seeing this phenomenon of competitive rents, where people are getting in and trying to rent properties and actually bidding up the rent on these properties. Well, you want $1,800, I'll give you $1,850, I'll give you $1,900. That's a recipe for disaster, guys. That is unsustainable. It just goes to show you how insane this market is right now. And I want to give a little bit of a warning about a couple of things I see on the horizon people are talking about in real estate. The first thing is, they're talking about expanding to 40-year mortgages. I tell you guys, the difference in payment between a 30-year and a 40-year is not enough to save house prices. It's just not enough. And I don't really see them doing that. And if they did, it's just further signs of bad stuff coming. Also, people have really good rates on their first mortgages, and they want to tap the equity that's still in their houses. So they're going now back to these tried and true old favorites, HELOC, home equity line of credit. Well, this time around it's a little bit different. This time, all these HELOCs are ARMs. So they're all adjustable rate mortgages. They all come with a 2-year or 3-year fixed rate to start you off something low. And then, of course, at the end of that time, these rates start adjusting up and your payment goes up with them. It's been my experience. I typically do not write HELOCs in my business. One of the big reasons I hate them is because now they've deemed that they don't want to give you a line of credit and you can just wait and withdraw the money at your leisure. They want you to take an immediate withdrawal the minute you close on the HELOC, and in some cases the withdrawal has to be above $75,000 to even get the loan. It's been my experience that people taking these HELOCs never pay them off. They just don't. The way they get paid off is they finally, when the rates start adjusting up and the payment becomes too much, they combine them and they refi the first and the second together into a new, bigger first mortgage, sacrificing that beautiful 3% rate they're having right now anyway. So if you're considering one of these, please be very, very cautious. Think it through all the way and figure out how long you'll need that money, because that'll just help you decide if this is something you're going to be able to live with when the rates start adjusting. Couple of last little things before we go today. For the oil guys who are suffering right now with oil being so terrible, the one good ray of hope is, and the one I'm looking at and I think might be a pretty good indicator that oil's still got a way to go up to the upside, Warren Buffett's getting into the oil market. He's already bought about 17.5% of Occidental Petroleum. I think Buffett getting into the market is a good indicator that there's a rally coming in oil. Another thing is just an interesting story I was reading. In Australia, a guy wanted to withdraw $15,000 in cash from his bank, and the bank would not allow it because he would not reveal what he wanted the money for. And he was indignant, refused to tell them what he wanted the money for, so they actually refused the withdrawal. That's not a good sign, guys. When you can't even get to your own money, when they're going to refuse you withdrawing your own money, hopefully that never gets to the United States. And our listeners in Australia, if you've heard anything about this, please in the comments let us know if this is something that's just a weird anomaly that's happened this one time, or if it's something more and more people are seeing there, because that would be something that would really, really, really be bad here in the United States. Anyway, I've been rambling on for a long time, guys. A lot of information today. As always, if you like the show, if you like the information you're getting, hit the like button. Share the information, share the videos with your friends. Please comment and ask questions. You guys have been doing a tremendous job asking questions and comments. I'll be there as soon as we get this blog, or get today's blog up and going. I'll be online answering your guys' questions. And of course, if you haven't already, subscribe to the channel. We really appreciate you guys taking the time to watch these videos. Looking forward to your questions in the comments. We'll see what tomorrow brings. It should be another interesting day. Until then, see you tomorrow. Thanks.